you are working on the accounts of Games Revolution, who is registered for VAT and has a financial year end of the 31st of December. Games Revolution has a policy of capitalising expenditure over £1,000, and plant and machinery is depreciated over 5 years on a straight line basis with no residual balance. Games Revolution received the following purchase invoice from the Games Maze. So on these items here, we've got a game making machine. Okay, we've got a serial number for that, so we've got a reference there, the quantity and the total amount, okay, of £5,000. We've then got testing on site for £750, and then we've got a maintenance contract for 36 months to the value of £3,600. So on the invoice, that's a total of £9,350 as the goods value. VAT at 20% added on top of that will give you a total invoice amount of £11,220. For the year ending 31st of December, record the following in the non-current asset register, with depreciation being calculated on an annual basis and charged in equal instalments for every month the asset has been owned. Okay, so a lot of information there, okay, that we're going to have to work out. Important things to look out for, okay, registered for VAT. Okay, so this is an important one here because here we can see that we've been charged VAT at 20%. Okay, we've got this amount of 1,870. If the business is not registered for VAT, then what that means is that it can't reclaim the VAT that it spent on purchases, and therefore that is also posted within the asset account. Okay, so it's that full amount which is the value of the asset, because we can't reclaim that amount of VAT. However, if you are registered for VAT, you can reclaim that back from HMRC, so we need to make sure that we're using the net figure here, okay, and not using any VAT. So always look out for that. So if they were not registered for VAT, we'd have to take that VAT into consideration. The policy is to capitalise expenditure over £1,000, and we know that we're spending £5,000 on the asset, so we can capitalise the additional costs. And the machinery is depreciated over 5 years on a straight line basis with no residual balance. So a residual balance is the value of the asset we expect it to be worth at the end of its useful life. Okay, so in this case, at the end of 5 years, what we're saying is this game making machine will have a zero value. So it'll either be scrapped or it won't be worth anything at all. Okay, and what we're doing is we're depreciating on the straight line basis over 5 years, which means we're charging an equal yearly amount over a 5-year period. Okay, so each yearly depreciation charge will be equal to 20%. So let's look at the items that we can capitalise here. We know that we could capitalise the £5,000, okay, because that's the asset and it's over the policy amount. Testing is definitely something that we can capitalise as well. Okay. However, we cannot capitalise the maintenance contract for 36 months. That would just be a general revenue expenditure item there. So the 3,600 doesn't form part of the capitalised non-current asset amount. So looking at that, let's start filling in this extract for the non-current asset register below. So the date acquired is the 1st of June, and we can get that from up here on the top right of the invoice. The cost then is the two items in green added together, So that'll be 5,750. Okay, they're the items that we can capitalise. We then have to look at what our depreciation charge is, and a key bit of information in the second part is that it's charged in equal instalments for every month the asset has been owned. So what we're going to do is work out what a yearly charge will be, and then we'll proportion that down to the amount of months that the asset's been owned within that year. So the way we do that, we'll start with 5,750 because that's the cost, and we'll divide that by 5 because that's the amount of years that we're depreciating over, which gives us a yearly cost of £1,150. So that's the depreciation cost per year. Okay. However, we now need to look at how many months the asset has been owned within that year based on the policy here. Okay, so if we do 1,150 divided by 12, so we know that that's the amount for 1 month. Okay, and then if we times by the 7 months that the asset has been owned, that should give you an amount of £670.83. Okay, so looking at, we bought the item in June, okay, and the year end is at 31st of December. Okay, so end of June 1 month, July, August, September, October, November, December. So 7 full months there. So the depreciation charge for the year will then be £670.83, which gives a carrying amount of £5,079.17. That's the difference. The carrying amount is the difference between the at cost amount, so that 5,750, and the depreciation charged at the end of the financial year. Okay, what we're saying is that over that period of time from when we bought the machine to when we've now reached our financial year end, that it's lost a value of £670.83, giving it a carrying amount or a current value of £5,079.17. Okay. Do look out for the policies that are given to you in the scenario. Okay. Sometimes you may be working with what we've got here, where it's depreciation is charged in equal installments for every month the asset is owned. Sometimes you can get a full year is charged in the year of acquisition, or maybe no depreciation is charged in the year of acquisition, and then it may be the same at the opposite end where no depreciation is charged in the year of disposal. So just look out for the information given to you, because you will have a variety of scenarios to deal with, and again, it's down to each individual business's policy. Okay, whatever a business does do in a real life situation, they'll need to be as accurate as possible when looking at how they depreciate their non-current assets. Okay. Okay, so let's look at number 7. So you are working on the accounts of Windows perspective, and you may ignore VAT in this task. The following item of office equipment has been sold. So a boardroom table sold for £900 at the end of June 2017. Windows Perspective's capital expenditure policy is capitalising items over £500. Office equipment is depreciated at 20% per year on a diminishing basis, and a full year's depreciation is charged in the year of acquisition and none in the year of disposal. Update the following non-recurrent asset register to record the details of the boardroom table for depreciation charges, carrying amount, disposal proceeds, and disposal date. So again, a lot of information here, okay? And this is what we've got to pick out from this. So we know that the table was sold, okay, at the end of June 2017. Okay, from the extract below, we can see that it was acquired on the 1st of March 2015 at a cost of £2,800. So that's really important information there, because we need to be able to work out the charges for depreciation for the year and the carrying amount. Okay, so important to recognize that that's already in there, even though it's not given to us specifically at the top part of the task. Okay, the policy is to capitalise items over £500. We know that we spent £2,800 on it, so that's absolutely fine. Now, office equipment is depreciated at 20% per year on a diminishing basis. So in the previous example, we looked at straight line basis. Okay, a straight line basis is the same amount charged each year, okay, whereas the diminishing balance basis is a percentage charged on the carrying amount, and it's specifically the carrying amount each year. Okay, what you'll notice in a difference between the two is straight line method is always the same charge each year. Diminishing basis, it will have a higher charge in the earlier years, but then it will gradually become less and less as the years go on. So when you're comparing that with straight line, it will start higher in the earlier years, but then it will actually fall lower in the later years. So again, it's down to each individual's business's policy as to which method they use, but typically diminishing basis will be used on assets that lose value quickly. So for example, vehicles. Okay, you buy a new car, as soon as it's out of the garage, it's lost most of its value. So diminishing basis might be a more appropriate method there. And again, a full year's depreciation is charged in the year of acquisition and none in the year of disposal. Okay, that's going to form an important part of this as well. So let's have a look at calculating the depreciation here. So year end is the 31st of December. Okay, so at the end of 2015, the asset at cost was £2,800. So working on the diminishing basis, we're just going to charge 20% depreciation to that figure. So 2,800 times 20% should give you £560. So our first year depreciation charge is £560. This then gives us a carrying amount of £2,240. Okay, the difference between what we paid for it and the depreciation we've charged. Okay, so 2,800 minus 560 equals 2,240. Then we get to year end of 2016. Now, this time, when we're calculating our 20% depreciation, remember that we're always doing this based on the carrying amount. Okay, so we'd do 2,240 and then we'd times that by 20%, which should give you 448. So that would be the depreciation charge for the end of that year. And then we can do 2,240 minus 448 to get a carrying value of 1,792. Okay. Then we get to year end 2017. Okay. And this is a bit that can catch people out, and this is where we have to look back at our policy. So, full year's depreciation is charged in the year of acquisition and none in the year of disposal. We know that the boardroom table was sold for £900 at the end of June 2017. So June 2017 falls into this financial year. So because we know that there's no depreciation charged in the year of disposal, the depreciation charge is going to be 0. However, if that wasn't the policy, then we'd just follow the same process as we've done above. Okay, we would take the carrying amount of 1,792 and times it by 20%. However, we're not doing that based on the policy given to us in this scenario. So always look out for that. And that also means that the carrying amount is 0 because it no longer belongs to the business. What has happened is we've sold it for £900, so we can enter that into the disposal proceeds, and then we'll enter the date there as 30th of June 17. Okay. So a good example of a question that you're going to come up against here, and again, it's really just taking note of those key details within the scenario. That will likely be the areas that might lose you marks if you just miss out on something like that policy there, for example. So we've looked at how we record assets when at the point of acquisition, and we've looked at this question here now where we've charged depreciation each year up until its year of disposal. Okay. Now we're going to have a look at another question where we're going to look at some of the different accounts that we use and how we record this depreciation, okay, which we've done in the previous question, over the amount of years. So Optimum Kitchens is a sole trader business who is VAT registered. The business year end is 30th of April 2004.
Hi there, and thank you for watching the video. If you're new here and passionate about everything accounting, then don't forget to subscribe and give us a follow. We're proud to deliver the best standard of support to our students. We have bespoke study materials, exclusive AAT unit videos, award-winning tutors, and so much more. Make sure to follow us on our social platforms to stay up to date with what we're working on. Thank you.